going. So as I just told you, let me repeat this. I just said that suppose you had an asset for which you had computed the impairment loss, and say you had the impairment loss of 10 million. We know that you have to debit something, but also you have to credit something. So the asset is falling in value. That means that's why it has been impaired. Since the asset is of a debit nature, so you will credit your asset here. So credit the asset by 10 million, 10 million here, but also you debit your asset. You debit the impairment loss. Impairment loss, that means is also 10 million. And this is how you do the double entry about the impairment losses. So don't ask yourself, oh, how do I know this? It's something very much obvious. You had your asset, it fell in value. So you credit the asset because the asset is of a debit nature. And so the obvious balance would be the impairment loss. And actually impairment loss is an expense. And so it will be taken to the statement of profit or loss, right? So this is all about accounting for impairment. So I think we could proceed further. Let's proceed further here. We are told that an impairment loss is normally charged immediately in the statement of profit or loss and the other comprehensive income. I think we have spoken about this already. Actually, it is a statement of profit or loss and other comprehensive income, but under the section of profit or loss. Now we are told if the asset has previously been revalued upwards, this is for when you could have non-current assets like say PPE. PPE it can be revalued upwards. It's just simple as this. If your asset was revalued upwards and then you identified that there is an impairment loss, you treat the impairment loss as if it is a revaluation loss. Do you know how to treat a revaluation loss? Revaluation loss is just treated as an expense too. It is taken to the statement of profit or loss. But as you know that, I don't know if you know or not, if you have your asset and it was revalued upwards as a revaluation gain, let's say you are using the revaluation model and it was revalued upwards, that revaluation usually goes to the other comprehensive income, not to the profit or loss. So if you find that there is an impairment on the previously asset that was revalued upwards, that impairment loss, instead of being taken to the statement of profit or loss, it would first be taken to other comprehensive income to provide for that previous upward revaluation. And then the remaining balance would then be taken to the statement of profit or loss. So simply speaking here is that for previously revalued assets in the upward manner, impairment loss is just treated as if it was a revaluation loss. You have to understand that. So the impairment is recognized as a component of other comprehensive income, as I told you here, as I just told you. Take it to the other comprehensive income instead of to the profit or loss, and is debited to the revaluation reserve. Actually, if you take it to other comprehensive income, that means it has gone to cancel the revaluation gain, the previous revaluation gain. And since revaluation gain usually goes to revaluation reserve or revaluation surplus, then this impairment loss too should go to the revaluation reserve and be debited so as to reduce it. So I hope you have got this well. All right, the new member, welcome. The new member, welcome Ahmed. Welcome Ahmed. So I hope everything is clear. That's why, as I told you, you take it to the other comprehensive income until the surplus relating to that assets has been reduced to nil. And the remainder of the impairment loss is recognized in profit or loss. What do I mean by this? Actually, I could show an illustration here so that you get me well before going to an example. Let's take a look now. Let's go here. Previously, I told you that we had an asset which we computed the impairment loss and found it to be 10 million. And then this is what we did. We said we have to debit something and then we have to credit something which is an asset. we said, let's say you have to credit our asset for 10 million. Sorry. If they told you that you have to credit our asset for 10 million and we have to debit impairment loss, that's very right. We would have to debit the impairment loss of 10 million. This one, 10 million. Now, after doing this, impairment loss is usually impairment loss is taken to the statement of profit or loss. Now, be very careful. Listen very carefully here. This is what we usually do. But in the case this asset was previously revalued, let's say it was previously revalued, and we had the revaluation gain of, let's say, 7 million. If you had the revaluation gain of 7 million, as you know, revaluation gain actually usually goes to the other comprehensive income. And if this was the case, this impairment loss, instead of taking it wholly to the statement of profit or loss, we would first have to take it to other comprehensive income. So instead of taking this 10 to the profit or loss, we would first debit this impairment loss of other comprehensive income of 7 million, and then the remainder, which is 3 million, would actually come here. So we'll have something like this. So this impairment loss of 10 would be accounted for this way: 7 million to other comprehensive income to cancel the previous revaluation gain, and the remainder 3 million being taken to the statement of profit or loss. This is what we would have done. I hope all is clear. So let's just proceed a bit here. Just be relaxed. About 10 minutes, I think we have completed. So the recoverable amount of the asset is then depreciated or amortized over its remaining useful life. Let's say you have impaired the asset already, and you have your figure. If the asset was previously was just having 7 years remaining, you just proceed as normal. You just continue depreciating it just like that. Not much more. Actually, this last sentence here is obvious. I didn't have to put it here. Now let's just take out indicators of impairment. Let's say you are the accountant of the company, you need to advise maybe the board of directors, suppose they got no knowledge about impairment of assets. Indicators of impairment, it's not like for every asset we just go and perform impairment review each year. No. Normally, actually, there are exceptions that we'll see later, but what actually happens is that to make impairment, to perform impairment test, you have to compute that fair value at the top as we saw. We have to compute to identify cost of disposal. You have to identify value news, which is very difficult to obtain, because to obtain value news, you have to ask yourself, how much will this asset generate after 1 year, at the end of the second year, at the end of the third year? And at the end of the third year, if I decide to sell it, at what amount would I be able to sell it? It's very difficult. So that's why we say that usually to impair an asset, you have to check, to perform that test, you first have to check the indicators of impairment. For most assets, if there are no indicators, no impairment. If there are indicators, now you perform the impairment review to see whether there is really an impairment or not. So here we go. We say that IAS 36 requires that at each reporting date, an entity must assess whether there are indicators of impairment. An entity must assess whether there are indicators of impairment. So we have to know, are there indicators of impairment or not, so that we perform the impairment review. That's why we say indications may be derived within the entity itself, which is internal sources, or external market, which is external sourcing. You could understand this by looking at inside the company or outside it. So that's why we say here external sources of information. Actually, most of these points you can just make them. If you take a look at how you arrive at the recoverable amount, that reflects it all on obtaining these points. Let's just go and you'll find it. Just remember one thing before checking these points. Fair value less cost to sell, you need fair value. Value news, you need to know the cash flows in the future. But also the value news, if because you have cash flows in the future, you have to discount them to obtain the present value. By discounting, you need the discount rate. So the discount rate changes, you also have to check whether there has been an impairment or not. So check these points and you'll just find it much, much easier. All right. So here we go. We say that the asset's market value has declined more than expected. You know, the market value is the basis for computing fair value. So if the fair value falls, that means there is a possibility that the recoverable amount will fall. This is number one. But also changes in the technological, market, economic, or legal environment have had an adverse effect on the entity. Let's say the market has changed, there have been technological changes. There could be adverse effect on the entity, and so the value of the what you expect to derive from the asset would have changed. Let's just we are just completing this page, and then we go to one example, and then that will be for today. Just another example here. Interest rates have increased. You know, interest rates form part of the discount rate that you use to discount the future value of cash flows. So interest rates have increased, thus increasing the discount rate used in calculating the asset's value in use. Increase of interest rates would increase the discount rate, and this would be a problem. Also, the entity's net assets are measured at more than its market capitalization. Let's say the net assets of the entity are measured actually at more than the value of equity. You know, net assets equals to equity. Net assets are measured above the value of equity. This actually would also lead to something like this. So let's go to other factors, which are internal sources of information. You as a company could just check internally to identify that there are indicators of impairment so that you perform impairment review. Let's say there is an evidence of obsolescence or damage to the asset. Oh, you have your asset and you see that there is a damage. If there is a damage, that means the asset won't be able to make cash flows it was previously making. So this would lead to decrease in value in use. This could lead to the decrease in value in use, and the decrease in value in use actually could what could then do? The decrease in value in use could lead to the probability that the recoverable amount would be low. The recoverable amount being lower means that there is a possibility of impairment. Also, we are told here that changes in the way the asset is used have occurred or are imminent. Let's say that you have changed the use of the asset. Maybe the asset, let's say you had a car. Initially, the car was being used for one purpose. Let's say it was being used as part of carrying assets to the customer. But now you just want to use that asset maybe to perform other functions. Maybe let's say you just want to use it for business, just for carrying cargos for just other companies. Maybe if you change that, the asset will be generating less much amount than before. So you could use that. But also you're told here that evidence is available from the internal reporting indicating that the economic performance of an asset is or will be worse than expected. If you just have evidence from internal reporting, maybe you prepared financial statements and just by analyzing them, you just come to a conclusion that economic performance of the asset is or will be worse than expected. That means the asset's capacity to generate cash flows has fallen. All right, so those are just sources of information. Now understand this. This is a very, very much important point that a lot of people skip, but you have to be careful here. If an indicator of impairment exists, if there is an indicator of impairment, which are just checked here, then an impairment review must be performed. I hope you got that. If there is an impairment, then impairment review must be performed. So impairment review is just not performed just every year, no. You first check if there is an indicator of impairment and then you perform it. But there are exceptions. There are exceptions at which point you will have to perform annual impairment reviews. No way. No need to check for indicator of impairment. For these special cases, you just have to perform impairment, just to perform impairment review directly, just like that. So we say that where there is no indicator of impairment, there is then no further action need to be taken. This is the norm. So the norm, no indicator of impairment, no need to perform impairment review, no need to check the value news, no need to check the fair value less cost to sell, no need at all. But we say that there is an exception. Exception here. What of this exception now? What of this exception? First of all, goodwill acquired in a business combination. Have you ever seen something called consolidation of financial statements? When consolidating financial statements, when combining the results of different entities that are of the same group, we usually form goodwill. Goodwill acquired in a business combination actually always requires performance of an impairment review at the end of each period, at least at the end of each period. You must perform an impairment review. No need to check for indicators of impairment. I hope you got me. But also an intangible asset with an indefinite useful life. You know, if an asset has indefinite useful life, that means you cannot amortize it. You know, amortization is the depreciation of intangible assets. So if it has indefinite useful life, that means there is no way to change that amount or its amount. So you must perform impairment review at the end of each period. And lastly, we are told here an intangible asset not yet available for use. If you have an intangible asset not yet available for use, let's say you know, an example of an intangible asset could be research and development. Now, let's say you have an asset, you are developing your asset. You know, by developing your asset, there are costs that will be incurred that meet the definition, meet the measurement criteria, that meet the recognition criteria. So you have to include them in the asset. But remember, you will still be having your asset made. And so, if that is the case, this intangible asset would need to be reviewed for impairment at the end of which period to see whether that amount that you have recognized already has to be taken down a bit. So it's just like that. I hope you are just going to an example now. Yeah, let's just finish this slide here. I-36 requires, now be careful here. I-36 requires annual impairment reviews. I just use the term reviews at the end of which reporting period, which is usually 12 months. That's why they say it requires annual impairment reviews for these assets, irrespective of whether there is any indication of impairment. So as I told you, for these special assets, goodwill and business combination and these intangible assets with indefinite useful life or not yet available for use, you don't need to check whether there is an indicator of impairment or not. You have to perform the impairment review every year, at least at the end of every year. I think we are done here. We have done very well. So let's just go to an example and call the session for today. And then we'll come to check the reserve of impairment loss and its indicators. That's what I told you, cash generating unit is also fit. Let's just go for an example. We just do this one example or two. Actually, it's not that much of a big deal. We could just do one example for today. No need to go so fast. Now, just take a look at this example. The following information relates to three assets is at the end of the financial period. I hope you see these assets. We have asset A, asset B, and asset C. You have the carrying amount of the assets, this one, and you have the net realizable value, this one, and you have the value in use, this one, as you see here. Now, what are we required to do? What are we required to do? We are told here that determine the impairment loss for each of the three assets and pass necessary journal entries to account for this. So that's one. That's just what we need to do. Determine the impairment loss and pass the necessary journal entries, double entries. No need for narration, you just need to know how to pass them. So let's go here. How would we go? As I said earlier, we come to know whether there's an impairment loss or not, you compare carrying amount to the higher of net realizable value or the value in use. So you compare them and you take the higher amount. So starting with asset A here, you just take, let's just try to compute the recoverable amount now. For A, you compare 120,000 compared to 125. What is the high amount? The high amount is 125. You compare 125 against the carrying amount. Remember, the carrying amount is the amount that would still be in the statement of financial position or would still be deemed to be supposed to be included in the statement of financial position prior to the impairment review. So you compare. You have carried an asset at $100,000, but the recoverable amount is $125,000. We say that there is an impairment when you have carried an asset at an amount above its value. This one is less than this, does not exceed this one. So actually there is no impairment. So there'll be nothing to do. So we do this for asset A, for asset B, as well as for asset C. Now let's go to the solution. I put it here. Let's go to the solution. For today, we'll just do this one example. I think it will be enough. Oh, I don't see. All right, I think I just did this complex example. Let's just do it. Let's just do it here and complete everything. Let me just do it here. It's just a basic example, very basic, it's easy. So we could just do it here. Now let's start with asset A. Asset A here, as I told you, all we have to do is just something very simple. I told you just carrying amount to the recoverable amount. We just take the amount that we can recover. Carrying amount, the recoverable amount. Now starting with asset A, what is the carrying amount of asset A? Asset A's carrying amount, we see it is $125,000. Sorry, it's $100,000. So we write $100,000 here. You see it, eh? All right. Now we go to the recoverable amount. We say that the recoverable amount, you take the higher. It is the higher of the realizable value and the value in use. Now, realizable value is 120,000. Value in use is 125,000. Which is greater? Tell me, which is greater here? Hello? I need your response.
The greater one.
The greater between the 125, right?
Yes.
Yes. Now to know whether there is an impairment or not is that this amount that you have carried your asset in the statement of financial position should exceed the recoverable amount. If you cannot recover this carrying amount, that means there is an impairment loss. So will there be impairment loss here or not? Here we say no.
Will be there.
No, we don't compute the difference. We just take the impairment loss. That means that you have carried an asset at an amount that you cannot recover. But here it's not true. We have carried it at $100,000, but actually we can recover more than that. We can recover 125. So no impairment. Impairment is not merely the difference. Impairment is when what we can recover cannot match what we have recorded in the financial statements. Now, did you get me?
So when the recovered amount is higher than the
carrying amount, no impairment,
It means there's no impairment loss.
It means there is no impairment loss because there is no loss. Now you just listen carefully. By saying there is impairment is that You say that you have a $5 million car, but when you sell it or when you use it, you can only recoup 2 million. You can only recover 2 million. That's when we say there is an impairment. That is, we have recorded wrongly the amount. The amount is deceiving us. It looks like the asset is much worth more, but actually it's not like that. Do you get me now? Just like that. Now let's finish up. I think it just started raining, yeah? Now let's go to asset B and C and then we finish up. If you go to asset B, what is the carrying amount? Carrying amount of asset B is how much? Could you give me the carrying? 100 again? 100?
150.
It's 150. All right. So I write here 150 like this. And then tell me the recoverable amount. We take the high of what and what?
It's 125.
Because you compared 110,000 to 125,000. So the higher is 125, right? Yeah. So here you say, is there impairment loss or not?
I think is there because the carrying amount is the evaluation.
I mean, the carrying amount is
recoverable amount.
Yes, that means you cannot recover what you have justified, you have recorded. You cannot justify why you carried this. So you just take the difference there, 150,000 minus 125,000, and end up with $25,000. So we are told to do the double entry. How do you do the double entry now? You debit something and then you credit something. As I told you, impairment loss is an expense. So you debit the impairment loss, and this goes to the statement of profit or loss, right? Which is 25,000, and then you credit asset, which is asset B. Asset B, which is also $25,000. You are done. Let's finish up with asset C and close the session. Now let's go to asset C. So if you go to asset C, you ask yourself, what is the carrying amount for asset C? Could you please tell me the carrying amount of asset C? What is it? Hello? The asset C has a carrying amount 130,000. So you write 130 here, 130. And then you ask yourself, what can you recover? You compare the net realizable value, which is fair value less cost of to sell, $100,000, and value in use, which is $80,000. So you compare it and take the higher, which is 100,000. This one. So comparing them, you compare carrying amount and recoverable amount, you find that you can only recover 100 while you have recorded something at 130. That means the asset has been impaired. And so you compute the impairment loss, which is the difference between 130 and 100, which would give you 30,000. So you do the double entry, debit something and you credit something. So you debit the impairment loss, which you go through the statement of profit or loss by 30,000, and then you credit asset C. You credit asset C here. So by crediting asset C, you credit the asset by 30,000, just like that, and all is done about today. So for today, I just wanted this. Now you have to know that in some cases, you will not be given this net realizable value. You would have to compute them for yourself. Also, you won't be given this value news. You would also have to compute it by yourself, right? But it's just nice you have started with this example. But the next example for ACCA June 2012 actually is the one that is more complex. It got explanations, but also it got these factors here of time value of money. I advise you, if you haven't gone through my time value of money lectures, just go to the YouTube channel, go to the playlist, find time value of money, read that one. It will give you much light on these points here, how to compute
Okay.
value in use, because that's where the topic is covered. It's never covered in financial reporting. In financial reporting, we just apply it. So I advise you, actually, we just remain this one lecture there. It's just one lecture to go. So I advise you to go there and do what is necessary. All right. Yeah. So for
Yeah.
now, this is the
Tomorrow we